Hey everybody, Sam Fiorani from AutoForecast Solutions. As we do every year, we've taken a long look in the rearview mirror, checked the side mirrors, and adjusted our seat, and now we're peering down the road toward 2026 and beyond. Short version, the road is still paved, but it's bumpy. There are a few detours, and somebody clearly forgot to update the GPS. So let's talk about where the auto industry has been, where it's going, and why affordability has become the word that nobody in the boardroom wants to say out loud. Back in late 2024, things were looking pretty good. Inflation was cooling, unemployment was easing, economists were cautiously optimistic, which in economist terms is basically a standing ovation. Then 2025 happened. A new administration, a new round of tariffs, and suddenly the global economy learned again that supply chains do not like surprises. The US saw its 11-quarter GDP growth streak end early in 2025. Europe slowed down, China dipped below its symbolic 5% growth mark. Nobody fell off a cliff, but everybody definitely hit the brakes. Manufacturers tried to absorb tariff costs to keep prices reasonable, which is noble, but also unsustainable. Eventually, math wins. It always does. Inflation was supposed to be heading back towards the Fed's 2% target. Instead, tariffs showed up like an uninvited house guest and refused to leave. By the end of 2025, US core inflation is sitting around 3%, and unless tariffs change, it's not going much lower in 2026. Interest rates did come down, but not without drama. The Fed cut rates, but even that sparked disagreements. Some wanted bigger cuts, others wanted none. Fed Chair Jerome Powell's second term ends in 2026, and odds are we'll get a new chair who's a little more friendly towards lower rates. Lower rates sound good, but cut too fast and you risk inflation and rising unemployment. So yes, even monetary policy is walking a tightrope. Let's talk electric vehicles. When the $7,500 EV tax credit disappeared in the US, buyers did what buyers always do. They rushed to the stores. EV market share shot past 12%, then fell off a cliff to under 6% the very next month. That wasn't just an EV problem, it slowed the entire market. Automakers are now asking hard questions. How many EVs do we really need? Which models make money? And which ones quietly disappear? EVs aren't going away, but the gold rush phase is over. Hybrids and plug-in hybrids are back in fashion. Turns out they're the sensible shoes of the automotive world. Not flashy, but everybody ends up wearing them. Now let's talk about the biggest issue of all, affordability. The average new vehicle price in the US is currently over $50,000. That is not a typo. Vehicles under $30,000 are disappearing faster than physical buttons on dashboards. Subprime buyers mostly locked out. Loan terms stretching 6, 7, or even 8 years. Monthly payments rising. Late payments also rising. The new vehicle market is increasingly designed for buyers with household incomes above $200,000, while everyone else shops used. And here's the risk. If younger and middle-class buyers never enter the new vehicle market, they may never come back. The Trump administration has floated the idea of allowing very small, inexpensive vehicles in the US market. Think K cars. But convincing automakers to build $15,000 cars when they can sell $100,000 trucks? That's a tough boardroom conversation. Tariffs are now a permanent character in our story. Imported vehicle tariffs jumped from about 2.5% to roughly 15%, and higher in some cases. That hits automakers, suppliers, and ultimately buyers. North America's trade relationships are strained, especially with Canada and Mexico. The USMCA review is coming in 2026 and could reshape the region or fracture it. Meanwhile, Europe is dealing with slow growth, geopolitical tension, and influx of Chinese vehicles that consumers seem perfectly happy to buy. Globalization isn't dead, but it's definitely arguing with itself. Automaker mega mergers, not really happening. But suppliers, especially smaller ones, are under serious pressure. They invested heavily for EV volumes that never arrived. Some will survive, some will be acquired, some won't make it. Larger suppliers can adapt. Agile ones will pivot back towards ICE components as demand returns. The supply chain isn't broken, but it is tired. Autonomous vehicles are still coming tomorrow, and tomorrow, and tomorrow. Full autonomy remains a long-term project despite very confident press releases. What is real? Better driver assistance systems, software-defined vehicles, over-the-air updates, data as the next revenue stream. Automakers want to control the digital ecosystem, hence moves away from Apple CarPlay and Android Auto. Vehicles are becoming rolling computers. Whether customers like the software is still an open question. So what's the takeaway? The auto industry isn't collapsing, but it's recalibrating. Tariffs, affordability, EV reality checks, supplier strain, and global politics are all shaping the road ahead. The winners will be flexible manufacturers, honest planners, strong supplier partners, and companies that remember not everyone can spend $60,000 on a vehicle. Because eventually someone will build affordable vehicles again, and when they do, everyone else will wish they had gotten there first. For our full report, drop an email to AutoForecast Solutions or connect with us on LinkedIn. Thanks for watching. I'm Sam Tirani with AutoForecast Solutions. We'll keep watching the road ahead, bumps and all.